Namaste. In this clipping, I am making an effort to explain the credit multiplier process. The credit multiplier is also called as a deposit multiplier. Now, who creates credit? It is the commercial bank which creates credit. We all know that the commercial bank, it accepts deposits and it also lends. So these two are the primary functions of commercial banks. Now, out of the deposit, how credit is created is what is a credit multiplier concept all about, right? To understand the credit multiplier, there are two basic assumptions that are made. Number one, all the transactions are going to be routed only through the bank, right? Let me repeat, all the transactions that happen in the economy are going to be routed only through the bank. And number two, the commercial banks will be able to lend because they know that not all the depositors are going to withdraw their money on the same day. Out of past history, they will know on an average how many deposit and how many withdraw and so on. So, it would be possible for them to lend. The RBI, it fixes up the legal reserve ratio on the basis of which the credit can be multiplied. Now this legal reserve ratio, it composes of the cash reserve ratio or the CRR and the SLR. So what is the CRR? CRR refers to the net time and demand liabilities that the commercial bank maintains with the RBI. And SLR refers to the net time and demand liabilities that the commercial banks have to maintain with themselves. Now, to put it in a very simple language, the commercial banks they accept the deposits, and out of these deposits, part of the money is to be kept with the RBI. So the deposit that is kept with the RBI by the commercial bank makes up the CRR, and part of the deposits that is going to be retained by the commercial banks with them would make up the SLR. Now, over and above these two reserves that are to be maintained by the commercial bank, it is out of the excess reserve that they lend. Now, moving on to how actually the deposit gets multiplied. Let us assume there is this person A who is going to deposit 1000 rupees with the bank. Now in A's savings account, 1000 rupees is going to be deposited. Now the commercial banks can lend out of this. Of course, they will have to, now let me write this down as deposit, fine. And the loan amount that would depend on the LRR percentage that is fixed up by the RBI. Let's assume that 10% of the initial deposit is to be kept as LRR. So that means 10% of 1000 is going to be 100. So 100 will be kept as reserve. That would mean that the rest can be lent. So loan basically is the deposit minus the LRR, right? So in this case, in A's account, savings account, 1000 rupees is going to be the initial deposit, and it is 10% of this which is going to be kept as reserve, and the rest can be lent. So that means 900 can be given as a loan. Now let's assume that 900 is going to be given to another person B, right? Now the banks are going to give loans, they are not going to give directly the individual cash. So that would duly be deposited into B's account, B's savings bank account, right? The 900 will be deposited in B's savings bank account. So this is going to be the secondary deposit. This is going to be the secondary deposit from that initial deposit. So from this secondary deposit, once more, there is going to be 10% kept as a reserve, and the rest 900 minus 90, that would be 810. So the rest 810 can be lent to another person, C. So again, as banks normally do, this is going to be deposited in C's savings account. Once more, 10% of this is going to be retained by the bank with RBI and of course with themselves, and the rest can be lent, right? The rest can be lent. So this process, it continues on till the amount is going to fizzle down to zero, right? So how do we understand to what extent the credit has been created? Yes, so credit multiplier or the deposit multiplier can be understood as 1 by LRR. In this case, we have assumed that LRR is 10%. So that means the deposit multiplier in this case is 10, or money is going to multiply 10 times, right? So what is the entire credit creation? What is the entire amount of credit creation in the economy, or by how many times the money has multiplied? So to understand this, right, it would be the initial deposit into the deposit multiplier, which would give you the amount of money supply, increase in the money supply. So the initial deposit, we know it is 1000, right? And we have calculated the deposit multiplier as 10. So as per this example, 10,000 will be the credit that is created, right? And if you total this up, the LRR, that would be 1000, right? Now this one, obviously the deposit multiplier, that should total up to 10,000. Now how did we start? 10% of the initial deposit is kept as the LRR and the rest can be lent. So look at this. This initial deposit is still there, right? This 1000 is still there. But look at how many times this initial 1000 has multiplied to create more and more money supply, right? So out of 10,000, if 1000 is still there, then 9,000 is the amount that has been created as loans out here. So this is the credit multiplier process as it is done by the commercial bank. So credit creation is one major function of the commercial bank, right? Keep watching. Namaste.